Federal Bank had a softish Q4 FY22 impacted by family pension provision, lower non-interest income and lower interest margin. However, the stock has held up well, outperforming the Nifty as well as the Bank Nifty in the last 4.5 months. We feel the best is yet to come, and once the market turmoil abates, this could be one stock which could certainly re-rate. The gross slippage to NPA in FY22 at 1760 crores was lower than the previous 2 years. In fact, the fourth quarter gross slippage of 358 crores was lower sequentially, and thanks to higher recovery and write-off, the overall asset quality showed an improvement. Gross and net NPA at 2.8% and 0.96% respectively were sequentially lower. The bank also carries a decent provision cover of 66%. The benign credit cost of 45 basis points in FY22 stands testimony to the improved asset quality. The restructuring book of 3,963 crores was down sequentially and is largely secured. Overall collection efficiency of the bank is at a healthy 95%. Total stressed book therefore has trended down and was at 2.36% of average total assets as at the end of FY22. We expect stability in asset quality unless COVID makes a comeback or external factors drive an economic slowdown. In a rising rate environment like now, banks have an edge over shadow lenders thanks to their competitive cost of funds. And within banks, the ones with meaningful low-cost CASA and or stable granular retail deposits are at a vantage position. For Federal Bank, close to 95% of deposits are retail and granular in nature. While overall deposit growth in FY22 prima facie looks modest at a little over 5%, this is a conscious strategy on the part of the bank to shed wholesale deposits. Instead, it has opted for refinancing from NABARD at a much more competitive rate. CASA has grown faster in FY22 at over 15% and consequently, the overall share of CASA has improved to 37% from 34% in the year-ago period. Growth in retail deposits too was in double digits. Future re-rating of the valuation multiple would be contingent on pickup in growth and an improvement in interest margin that should result in an expansion in return on assets. For Federal Bank, the asset quality pain is behind. It has adequate capital, granular liability and competitive cost of funds. Although the bank has shied away from a branch-led expansion strategy, it has forged strong partnerships with fintech players that's likely to be an added driver of growth, both on the liability as well as on the asset side going forward. In FY22, growth in advances at 9.5% was almost at par with the industry. Growth from the non-wholesale segment was at 10.6% compared to wholesale segment's growth of 8.1%. Interestingly, the growth drivers were commercial banking and business banking, the mid-market segment which is a traditional forte of old private sector banks. The bank has been slow in ramping up corporate banking that is witnessing intense pricing pressure. The share of retail now stands at 55%. The bank is guiding to a much improved overall loan book growth of at least 15% in FY23. The ratio of risk-weighted assets to total assets at 55% points to a good underlying asset quality and creates the right backdrop for onboarding a little risky, high-yielding assets like lending to commercial vehicles, microfinance, credit cards, etc. as the economy opens up post-COVID. While the quarter saw sequential drop in interest margin thanks to agri slippage, the bank is confident of an overall improvement in NIM in FY23 and an expansion in return on assets. For Federal Bank, the deposit rates remain competitive and on the lending side, only 27% of loans are fixed rate and major part of the books gets eventually repriced as systemic interest rates move up. While growth, NIM and expansion of ROA remain key monitorables, given the strength of balance sheet and management bandwidth, we see that panning out over the next couple of years. Although higher operating expense remains a dampener, the impact should wane as growth picks up. Cost-to-income ratio was in excess of 53% in FY22 and should moderate to levels of 50 to 51% going forward. We see immense scope of valuation re-rating given its undemanding valuation of 0.9x FY24 adjusted book. And the current volatility in the market presents a buying opportunity.